right. So what type of loans do you offer?
Well, we do FHA, of
Okay.
course, and we do FHA requires 3.5% minimum down payment. Then you've got conventional. With conventional, you can put as low as 3% down, 5%, 10, 15, 20. If you can put 20% down, then you have no mortgage insurance.
Okay.
So let me talk about that for just a second.
Please.
So with mortgage insurance, on conventional, you need to have a pretty good credit score, or your mortgage insurance premium is going to be really high. Okay. But that being said, still, once you've got 20% of equity paid into your note, then you can drop that mortgage insurance without refinancing. But some people are not, they're not quite there where they can go conventional, so we take them FHA. And when we take them FHA, there's a upfront mortgage insurance premium that's rolled into the loan, and then you have a monthly premium. If it's on a 30-year note and they're only putting 3.5% down, then they're going to have that mortgage insurance for the life of the loan, and that multiplier is like 0.85. So if they put a little bit more down, then that mortgage premium number drops a little bit. But we just weigh it out to which one's the best for them. I also do VA loans. I love helping veterans. I mean, I so appreciate the service that they have given and put their life on the line for us, and I love to help them. They have 0 down payment. There is a misconception though. A lot of times veterans think that they can get into a house for 0 out of pocket. They can. However, we have to have a seller that's going to cooperate with that scenario. So the seller has to give some seller contributions to the loan to make that a 0. However, I just did a VA loan for a guy, and we did use a down payment assistance program with him, and he was only out of pocket about $1,000. So we can really help the veterans, with their scenario.
What's a seller contribution?
A seller contribution is where a seller is willing to give money towards your closing costs. So you're going to get a credit when you go to closing. You remember we had this form, it was called a CD, closing disclosure, and that lists out all the fees that it costs. So it's going to tell you your breakdown of what your down payment was, what your fees are, and that bottom line. Well, typically you're going to be credited for the earnest money that you put down when you put your offer in with your contract, and then you're going to get your option fee back if you paid for an option fee. You'll also get a credit typically of taxes from January 1 to whatever day you close from the seller, because they own the property during that time. So they're going to give a credit for that, and they're going to set that money in your escrow account. And now that's going to create another question. So what's an escrow account?
Yes.
An escrow account is where, don't you love that? So an escrow account is where you're setting up an account within your mortgage. They're going to put a little bit every month towards your insurance, your homeowner's insurance, and your taxes. So at the end of the year when they come due, there's enough money to cover that, and you're not trying to figure out where to come up with that money. The only way to avoid an escrow account is if you put 20% down, then you actually don't have to have an escrow account. But you've got to remember to have those funds at the end of the year when the taxes come due and whenever your homeowner's insurance is due.